Hello and welcome to another edition of Market Briefing. I'm Martin Bakkerdax, European business editor here at the IB Times UK. We're going to take a look at the week back and take a look at the next few days to find out what is going to be driving financial markets around Europe and indeed around the world. It's been a macro-dominated week, no question about it, here in Europe. We saw a modest advance for the major indices. The UK's FTSE 100 kind of leading the way, but really only gaining a little bit more than 1% off the back of some strength in the mining and the banking sectors. We saw modest declines for the week for the broadest measure of European equities, the FTSE Eurofirst 300, and also for the DAX as well. However, as I say, the macro theme was probably the most dominant. We had fourth quarter GDP measured at 0.6% in terms of contraction for the Eurozone. That's the steepest since at least 1995 and marks a full year in which there wasn't a single quarter of economic growth. That probably explains the record high unemployment and really probably explains the underperformance of a lot of assets inside the Eurozone. Now, next week we'll get some manufacturing surveys, and that will probably give us a sense of what's happening going forward, because it must be remembered that both GDP and unemployment are backward-looking indicators. So ultimately, the manufacturing data from next week and indeed an investor sentiment survey from the ZEW in Germany on Tuesday will also give us a guide as to what people are looking for in the coming months. Next week as well in the United States, we'll have minutes from the Fed's last interest rate setting meeting, as well as the same from the Bank of England, and they might give us a sense as to whether either central bank is prepared to be a bit more accommodative in terms of monetary policy. Now that's a big theme and will be over the weekend when G20 finance ministers meet in Moscow. Now they are talking about potentially trying to agree on allowing or not allowing any significant interference in currency markets as a result of domestic policy. And that's going to be a difficult agreement to come to over the weekend, and it'll be fascinating to see what communique the leaders deliver to us on Saturday. But the assumption from early leaks is that they won't be able to agree on some sort of mitigation of domestic policy and currencies, as was expressed in a G7 statement earlier this week. Now, whether or not that's going to mean a free-for-all in the currency markets or a continuation of this currency war theme that we have been exploring remains to be seen. But we'll keep an eye on it nonetheless. Another theme this week that was fascinating, of course, was mergers and acquisitions activity. So far this year, it's been about 280 billion worldwide. That's one of the fastest paces in at least 5 years, and does suggest again that there might be some more investor optimism in the markets in the months to come. Now that isn't being played out in the real economy just yet, but we'll see if we can connect the two over the next few days. That's it for us. Join us again on Monday and we'll have another wrap up. Until then, have a good weekend.